what Uniswap's latest proposal really means for UNI token buyers. The fee switch implies a 2.5% annual supply reduction, creating a quasi-buyback dynamic that directly links network activity with token scarcity. Uniswap's UNIfication proposal by Uniswap Labs and Uniswap Foundation seems to be a game-changer, as it could finally turn its massive but untapped trading volume into real value for UNI token holders. The plan proposes to activate long-delayed protocol fees, burn up to 100 million UNI, approximately $940 million at current prices, and consolidate development teams Uniswap Labs and the Foundation under a single operational and economic model. Uniswap's current $5.05 billion in total value locked TVL supports a $5.9 billion market cap and $9.4 billion fully diluted valuation, putting the protocol at a price-to-fees ratio near 4.7x, which is cheaper than comparable Layer 1 or Layer 2 plays when adjusted for realized on-chain revenue. The protocol remains DeFi's largest exchange by far, processing roughly $148.5 billion in trading volume over the past 30 days across 36 chains. According to DeFi data, its mainstay Ethereum-based service accounted for $15.9 billion, followed by BNB Chain at $4.7 billion and Arbitrum at $3.3 billion. That activity generated about $227.4 million in fees during the same period, annualized at $2.77 billion, but none of it currently accrues to UNI holders. However, under the UNIfication framework, roughly 1/6 of trading fees would flow into a protocol revenue pool, equivalent to about $130 million annually based on current activity. Combined with the proposed 100 million UNI burn, the fee switch implies a 2.5% annual supply reduction, creating a quasi-buyback dynamic that directly links network activity with token scarcity. All of this taken together could see Uniswap offer an implied yield of around 3% annually under moderate volume growth, positioning it as DeFi's first major cash flow governance asset. Implied yield represents the expected return a liquidity provider can earn from trading fees, calculated by assuming zero impermanent loss and solving for the asset's volatility. Yet the bigger shift may lie in structure, not yield. By folding the foundation into labs, Uniswap is effectively moving from a grant-based governance model to an execution-first operating company. That centralization may alienate some DAO purists, but it also mirrors what investors have demanded from DeFi blue chips: clarity, accountability, and measurable value capture. That strategy has helped tokens such as Hyperliquid's Hype, whose buyback mechanisms have propelled the token up 900% in the past year amid a generally flat year for the broader market. If passed, UNIfication would align Uniswap with a new phase of DeFi economics, one where token price is driven not by governance hype, but by real protocol earnings.